In today's video, we are doing a deep dive into NBFC accounting, covering the complete business flow, end-to-end accounting treatment, real-world journal entries, financial statement impact, common errors, and the kind of interview questions that companies actually ask. Whether you are preparing for a job interview, working in finance, or just building your accounting foundation, stay with us because this video covers everything. In this section, we will go through all the key concepts of business understanding in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Non-banking financial companies, NBFCs, play a crucial role in the Indian financial system. Unlike banks, NBFCs cannot accept demand deposits, but they provide loans and credit facilities. Major players like Bajaj Finance and Muthoot Finance have transformed access to credit. The NBFC sector has grown significantly, driven by demand for services in underserved areas. This growth reflects regulatory support and the sector's adaptability to economic changes. NBFCs, like Bharat Finance, generate revenue primarily through interest on loans and fees for financial services. They operate with lower operating costs than banks, allowing competitive pricing. Their major costs include borrowing expenses and administrative overheads. By focusing on niche markets like microfinance or vehicle loans, NBFCs effectively compete with traditional banks. Understanding this model is crucial for grasping how NBFCs sustain profitability and support economic growth in underbanked areas. In an NBFC, departments like finance, operations, and legal play vital roles in accounting. The finance department manages cash flows and prepares financial reports. Operations handle loan processing and customer service, affecting revenue recognition. Legal ensures compliance with regulations, which is critical in a highly regulated sector. Effective collaboration among these departments ensures accurate financial reporting and compliance, crucial for maintaining trust with stakeholders like investors and regulators. NBFCs follow a structured flow from loan application to disbursement and servicing. It begins with customer inquiry, followed by credit assessment. Approved loans move to documentation and legal checks before disbursement. Post-disbursement, loan servicing ensures timely repayments. This flow ensures efficiency and risk management, crucial for maintaining operational integrity. Understanding this process helps in identifying critical control points necessary for accurate financial reporting and compliance with lending regulations. NBFCs engage with multiple stakeholders, including clients, vendors, banks, and regulators. Clients impact revenue and cash flow through loan repayments. Vendors provide essential services, affecting operational costs. Banks offer funding lines, crucial for liquidity management. Regulators oversee compliance, key for operational legitimacy. Each stakeholder influences accounting practices, from revenue recognition to compliance costs, making their understanding essential for strategic financial management and ensuring sustainable operations. NBFCs face unique challenges such as managing a volatile working capital cycle and complex regulatory requirements. They often deal with high customer default risks, impacting cash flow stability. Regulatory compliance requires rigorous documentation and reporting, demanding precise accounting practices. For instance, the Reserve Bank of India mandates strict credit norms, necessitating detailed financial tracking. Addressing these challenges ensures NBFCs remain resilient and capable of meeting evolving financial needs. Accounting in NBFCs is distinct due to the emphasis on interest income and regulatory compliance. Unlike generic companies, NBFCs must track loan recoveries meticulously, impacting revenue recognition. Compliance with financial regulations is stringent, requiring precise documentation. For example, provisioning for bad debts is critical, affecting financial statements. These unique aspects necessitate specialized accounting knowledge, ensuring accurate financial representation and adherence to regulatory standards, crucial for maintaining operational legitimacy. In NBFCs, accounting entries are typically passed by the finance team upon specific triggers, such as loan disbursement or interest accrual. The accuracy of these entries is crucial for financial statements and compliance. For instance, an incorrect entry can misrepresent financial positions, impacting stakeholder trust. Finance teams use specialized software to ensure precision and efficiency. Understanding these processes helps in appreciating the rigor behind financial reporting and maintaining regulatory compliance. In this section, we'll explore the comprehensive life cycle of transactions within a non-banking financial company, NBFC, using Bharat Finance Company as our example. We'll delve into each step from tender initiation to reconciliation, highlighting the roles, documents, and systems involved. Understanding this process is crucial for ensuring accuracy and compliance in NBFC accounting. Bharat Finance Company begins with a tender request initiated by the Procurement Department. This request outlines the financial product requirements. The finance manager reviews and approves this tender to ensure alignment with company budgets. Documentation such as tender forms and budget reports are critical here. Any misalignment or error can lead to budget overruns or missed opportunities. Once approved, Bharat Finance Company prepares a contract, detailing terms with vendors. The legal department ensures compliance with regulations. Purchase orders, POs, are then issued, specifying quantities and prices. Systems like SAP or Oracle may be used for tracking. Errors in this phase, such as incorrect pricing, can cause financial discrepancies and legal issues. In this step, Bharat Finance Company processes advance payments through the accounts payable department using banking systems like SWIFT. Upon receipt of goods or services, a goods receipt note, GRN, is generated. This document is vital for inventory and accounting records. Any delay or error in GRN issuance can disrupt financial reporting and stock levels. During this phase, Bharat Finance Company tracks projects under development. The project management team updates work in progress, WIP, records in project management software. Once complete, a completion report is issued. Accurately accounting for WIP is crucial to reflect the company's financial position accurately. Misstatements here can lead to incorrect profit reporting. After project completion, Bharat Finance Company issues invoices via the billing department using invoicing software like QuickBooks. Payments are processed by accounts receivable. Ensuring timely and accurate invoicing is key to maintaining cash flow. Errors such as incorrect amounts or delayed invoices can impact financial liquidity and customer relationships. Finally, Bharat Finance Company conducts reconciliation to ensure that all financial transactions match between records and bank statements. The accounting department uses tools like Excel for analysis and correction of discrepancies. Accurate reconciliation is vital for financial statement integrity. Errors here can lead to misstated financial results and compliance issues. This flow diagram summarizes the end-to-end process in NBFC accounting, highlighting the interconnected stages from tender requests to period close. Each stage feeds into the next, ensuring a seamless flow of financial information critical for decision-making. Understanding the life cycle helps manage risks and optimize operations within financial companies like Bharat Finance. In this section, we will go through all the key concepts of accounting concepts in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Revenue recognition determines when a company records its sales, impacting reported earnings. This is especially crucial for NBFCs like Bharat Finance Company, which offer diverse financial products with different revenue streams. Indian Accounting Standard 115 guides NBFCs, emphasizing the transfer of control rather than just risks and rewards. For instance, when Bharat Finance grants a loan, revenue is recognized as interest accrues over time. Unlike general accounting, NBFCs must carefully consider the timing and pattern of revenue recognition due to their unique product offerings. Lease accounting is significant for NBFCs, which may lease office space or equipment. Indian Accounting Standard 116 ensures leases are accurately reflected on the balance sheet, requiring recognition of lease liabilities and corresponding right-of-use assets. For example, Bharat Finance must account for office leases, impacting their asset and liability balances. Unlike general accounting, NBFCs need to consider both operating and financial leases, affecting their cash flow and debt ratios. Provisions and contingencies are crucial for NBFCs, which must prepare for potential loan defaults or legal disputes. Indian Accounting Standard 37 guides how to address these uncertainties, focusing on recognizing obligations that are both probable and measurable. For Bharat Finance, Setting aside provisions for potential non-performing loans is essential for maintaining financial health. Unlike general accounting, NBFCs need precise forecasting to manage complex risk profiles and meet regulatory requirements. Segment reporting helps NBFCs like Bharat Finance analyze performance across different business lines, such as lending and investment services. Indian Accounting Standard 108 requires financials to be broken down by segments, aiding stakeholders in understanding performance and resource allocation. For Bharat Finance, reporting on loan and investment segments helps in strategic decision-making and transparency. Unlike general accounting, NBFCs must carefully segment data to reflect diverse operations and meet investor expectations. Deferred revenue occurs when NBFCs receive payments for services not yet delivered, common with upfront fees. Indian Accounting Standard 115 also covers this area, ensuring revenue is not recognized until the service is provided. For Bharat Finance, upfront processing fees on loans are deferred until the loan terms begin. This contrasts with general accounting, where service timelines are less complex, highlighting the need for precise revenue timing in NBFC operations. Foreign currency accounting is key for NBFCs involved in cross-border transactions affecting loan and investment valuations. Indian Accounting Standard 21 guides how to account for foreign currency, emphasizing the impact of exchange rate fluctuations on financial statements. For Bharat Finance, dealing with foreign investors or clients requires translating foreign currency items into the reporting currency using the applicable exchange rates. This is more complex than general accounting, as NBFCs must manage currency risk to ensure accurate financial reporting. Cost allocation helps NBFCs assign costs to various services like loans and insurance, ensuring each product's profitability is clear. Though not governed by a specific standard, management accounting principles guide this process. For Bharat Finance, allocating administrative overheads to specific financial services helps in pricing and profitability analysis. Unlike general accounting, NBFCs must navigate complex service structures, making precise cost allocation essential for sustainable financial management and strategic planning. Fixed assets and depreciation are crucial for NBFCs, which invest in long-term assets such as office buildings and technology. Indian Accounting Standard 16 provides the framework for asset valuation and depreciation, ensuring these long-term investments are accurately reflected in financials. For Bharat Finance, calculating depreciation on office equipment affects both asset values and expense recognition. This differs from general accounting, as NBFCs must consider how asset valuation impacts their capital requirements and financial stability. In this section, we will go through all the key concepts of journal entries in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Recording initial capital investment is crucial, as it reflects the cash inflow from shareholders, which enables Bharat Finance to start its operations. This transaction increases the bank balance and creates share capital as a liability that the company owes to its investors. Properly accounting for capital ensures transparency in ownership and financial resources available for business activities. Purchasing office equipment is a capital expenditure necessary for the company's operations. The cost is debited to recognize the asset, as it will provide future economic benefits. Crediting the bank account reflects the outflow of cash. Tracking such assets is vital for depreciation calculations and asset management, impacting long-term financial health and operational efficiency. Acquiring financial software is categorized as an intangible asset due to its non-physical nature and long-term value. The software enhances service delivery and operational capacity, crucial for a finance company. Recognizing it as an intangible asset allows for amortization over its useful life, ensuring expenses match revenues it helps generate, which is key in financial performance measurement. Securing a business loan provides Bharat Finance with additional funds needed for expansion or operational needs. The bank account is debited to reflect the inflow of cash, while the credit entry under long-term borrowings signifies the obligation to repay the loan over time. Managing debt effectively is crucial for maintaining liquidity and ensuring sustainable growth. Investing in marketable securities is a strategy to make use of excess funds, generating returns without hampering liquidity. These are short-term investments, reflected as current assets, easily convertible into cash if needed. Such investments are crucial for optimizing cash management and providing a buffer against unexpected financial needs in the finance industry. Issuing loans to clients represents Bharat Finance's core operational activity. It is crucial to record these as loans and advances, indicating expected future cash inflows and serving as a primary source of revenue. This transaction reduces the immediate cash balance, but is strategic for revenue generation through interest income, a fundamental aspect of finance companies' profitability. Interest income is a primary revenue stream for finance companies like Bharat Finance. Recording interest receipts increases the cash balance and recognizes revenue, impacting profitability. Timely recognition of such income is crucial for accurate financial analysis and ensuring compliance with revenue recognition principles, providing insights into operational health and loan portfolio performance. Repaying part of the business loan reduces the company's liabilities, reflecting a strategic approach to managing debt. It also improves the company's creditworthiness and reduces interest expenses over time. Recording such transactions is essential for maintaining accurate records of obligations, supporting better financial planning and stability in the finance sector. Payment of operating expenses is essential for the ongoing functioning of Bharat Finance's daily business activities. These expenses are recorded as a debit to indicate an expense that reduces net income, while the credit to the bank shows cash outflow. Managing these expenses effectively is crucial for maintaining operational efficiency and optimizing profitability in a competitive finance landscape. Recording depreciation is vital for matching the cost of office equipment with the revenue it generates over time. Depreciation reflects the wear and tear of assets, impacting both the balance sheet and income statement. By systematically allocating the asset's cost, Bharat Finance can assess asset utilization and ensure accurate financial reporting, aiding strategic decision-making. Creating a provision for doubtful debts acknowledges potential loan losses, a conservative accounting practice in finance. It prepares Bharat Finance for future defaults, impacting profitability and cash flow forecasts. This provision aligns with prudence, ensuring financial statements reflect realistic asset values and support reliable decision-making by stakeholders concerned with credit risk management. In this section, we will go through all the key concepts of financial statement impact in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. In the balance sheet of Bharat Finance Company, current assets like cash and cash equivalents and accounts receivable increase when loans are disbursed. Conversely, accounts payable reflects obligations incurred. These changes impact liquidity and working capital management, crucial for NBFC operations. Understanding these dynamics helps anticipate cash flow needs and financing requirements, ensuring operational stability. For Bharat Finance, non-current assets such as long-term loans and fixed assets reflect investment in long-term growth. Increases in shareholders' equity through retained earnings suggest profitability and reinvestment. These components are critical for assessing the company's financial health and growth potential, indicating stability and capacity to expand operations. Analyzing these trends offers insight into strategic decision-making and future opportunities. In Bharat Finance's profit and loss, interest and fee income constitute primary revenue streams, driving gross profit. The cost of funds impacts overall profitability, reflecting the expense of sourcing capital. Understanding these elements helps identify profit margins and pricing strategies, enabling better financial planning and competitive positioning. Analyzing revenue versus costs provides insights for optimizing operational efficiency and increasing shareholder value. Indirect expenses like administrative and marketing costs affect Bharat Finance's EBITDA, a measure of operational profitability. EBITDA provides a clearer view of core earnings, excluding non-operational costs. Profit before tax further refines this by considering interest and depreciation, essential for assessing pre-tax profit. These metrics help evaluate cost management and operational efficiency, guiding strategic decisions on cost-cutting or investment in growth. Cash flow insights are vital for Bharat Finance's sustainability. Operating cash flow reflects daily business efficiency, while investing and financing cash flows indicate strategic growth and capital structure. Positive operating cash flow supports operational stability, whereas investing cash flow reveals asset acquisitions or disposals. Financing cash flow shows debt and equity financing activities. Together, these reveal liquidity and capital allocation efficiency, essential for long-term viability. Key ratios are indispensable for assessing Bharat Finance's financial health. The current ratio evaluates liquidity, indicating the ability to cover short-term obligations. Return on assets, ROA, measures efficiency in using assets to generate profit. Debt-to-equity ratio assesses financial leverage and risk, while net interest margin reflects profitability from lending activities. Together, these ratios provide a comprehensive view of financial performance and strategic positioning. In this section, we'll uncover common errors in NBFC accounting like those Bharat Finance Company might encounter. Understanding these mistakes is crucial for accurate financial reporting and compliance. We'll explore audit findings, interview traps, ERP system challenges, cutoff errors, and more. Each slide will delve into a specific error, its root cause, and the correct accounting treatment to ensure your financial statements remain reliable and trustworthy. Audit findings are a crucial checkpoint for NBFCs like Bharat Finance. Often, errors arise from misinterpreting the specific regulatory requirements governing NBFCs. This happens when companies fail to keep their compliance checklists up to date, or staff are not adequately trained in the latest regulations. Such misinterpretations can result in misstated financial statements, attracting regulatory scrutiny and potential penalties. Auditors typically detect these issues by cross-referencing financial reports with current regulations, highlighting the importance of continuous training and compliance updates. During interviews for NBFC accounting roles, candidates at companies like Bharat Finance might fall into traps that test their practical understanding of accounting standards. These traps often focus on real-world applications beyond theoretical knowledge. The root cause is usually a lack of hands-on experience in applying accounting principles to NBFC-specific transactions. Correcting this involves gaining practical exposure to such scenarios. For instance, candidates should familiarize themselves with handling complex financial instruments. Interviewers typically use scenario-based questions to assess a candidate's depth of practical knowledge and problem-solving skills. ERP systems are essential for managing complex financial data at NBFCs like Bharat Finance. However, configuration mistakes can occur, particularly when setting up NBFC-specific modules. These errors often stem from inadequate customization or insufficient understanding of the company's unique requirements. Such misconfigurations can lead to inaccurate data flow and ultimately result in financial misstatements. The correct treatment involves engaging knowledgeable IT and accounting professionals to tailor the ERP system accurately. Auditors might detect these discrepancies during data integrity checks, which highlight inconsistencies between reported figures and actual transactions. Cutoff errors are prevalent during the financial closing processes in NBFCs like Bharat Finance. These errors occur when transactions are recorded in the incorrect accounting period, often due to rushed or poorly managed closing procedures. Such mistakes can mislead stakeholders by inaccurately portraying the company's financial position. Accurate cutoff procedures ensure that revenues and expenses are matched correctly, maintaining the integrity of financial statements. Auditors typically identify these errors by reviewing transaction dates and ensuring they align with the correct reporting periods, emphasizing the need for meticulous period-end procedures. Switching between accounting standards, such as transitioning from Indian generally accepted accounting principles to Indian accounting standard, poses significant challenges for NBFCs like Bharat Finance. Errors frequently arise from a lack of understanding of the new guidelines, leading to misapplication of accounting treatments. This can result in inaccurate financial reports and non-compliance with regulatory requirements. The correct approach involves comprehensive training and phased implementation to ensure all stakeholders understand the changes. Auditors often detect these errors by comparing financial statements against both old and new standards, ensuring consistency and compliance throughout the transition. In this section, we will go through all the key concepts of interview questions in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. NBFCs, like Bharat Finance Company, provide banking-like services but don't hold a banking license. They offer loans, asset financing, and investment services. Unlike banks, NBFCs can't accept demand deposits and do not form part of the payment and settlement system. This allows them to have more flexibility in offering tailored financial products, making them vital for reaching underbanked and niche markets. When Bharat Finance disperses a loan, the entry involves debiting the loan receivable account to recognize the asset and crediting the bank account for the outflow of funds. This reflects the company's expectation to receive payments in the future, while reducing its cash balance at present. For example, if a loan of INR 100,000 is dispersed, loan receivable is debited and the bank account is credited with INR 100,000. Under Indian Accounting Standard 109, Bharat Finance recognizes interest revenue using the effective interest rate (EIR) method. This approach allocates the interest income over the expected life of the loan, considering all contractual terms and initial transaction costs. It ensures revenue reflects the time value of money, offering a more accurate financial picture. For instance, if a loan has an EIR of 8%, interest is recognized periodically based on this rate, not just on a cash receipt basis. Bharat Finance uses the Expected Credit Loss (ECL) model under Indian Accounting Standard 109 for provisioning loan losses. This model considers historical data, current conditions, and forecasts to estimate potential credit losses. This proactive approach helps in recognizing credit risk early, ensuring financial stability. For instance, if economic indicators suggest a downturn, provisions may increase, affecting profit and loss, but safeguarding against future defaults. Fair value measurement, as per Indian Accounting Standard 113, involves estimating the price at which Bharat Finance could sell an asset or transfer a liability in an orderly transaction. This includes using market data and valuation techniques like the market, income, and cost approaches. For a financial instrument like a derivative, observable market inputs are preferred. This method enhances transparency and comparability across financial statements, crucial for stakeholders' decision-making. International Financial Reporting Standards 9 significantly impacts NBFCs like Bharat Finance by introducing the ECL model for credit loss provisioning and changing how financial instruments are classified and measured. This model requires a forward-looking approach affecting profit and loss and balance sheets by recognizing potential losses earlier. The standard's focus on transparency and risk management enhances investor confidence, but demands robust data systems to track economic and credit conditions accurately. ERP systems streamline accounting processes in NBFCs like Bharat Finance by integrating financial data across departments, enhancing real-time reporting and compliance. They automate tasks such as loan processing, interest calculations, and financial reporting, reducing errors and increasing efficiency. For instance, SAP can handle complex loan portfolios, ensuring timely data consolidation and aiding strategic decision-making. This leads to improved transparency, operational control, and regulatory adherence. Complex loan structures, such as those with embedded derivatives or variable interest rates, require careful accounting. Under Indian Accounting Standard, Bharat Finance must separate embedded derivatives from the host contract if they meet certain criteria, accounting for them at fair value. This affects financial statements by potentially increasing volatility in profit and loss due to market changes. Accurate measurement and disclosure are crucial for transparency and investor confidence. When Bharat Finance writes off a loan due to default, the loan receivable account is credited to remove it from the books, and an expense account is debited to recognize the loss. This impacts financial statements by reducing asset values and increasing expenses, affecting profitability. However, recovery efforts may continue, and any future recoveries should be recognized as income, reflecting the ongoing pursuit of value, even after write-off. NBFCs, like Bharat Finance, can have deferred tax assets if there are temporary differences between accounting and tax bases of assets and liabilities, which will reverse in the future. For example, if loan loss provisions are recognized in financial statements, but not for tax purposes until actual loss, a deferred tax asset arises. This reflects future tax benefits, but recognition depends on the likelihood of sufficient taxable income to utilize these benefits. Understanding the business model of NBFCs like Bharat Finance is crucial. They engage in lending and investment, mainly generating revenue from interest on loans. Unlike banks, NBFCs cannot accept demand deposits. They manage credit risk by assessing customer creditworthiness and diversifying portfolios. Operating under RBI regulations, they ensure compliance for financial stability. Key processes include the loan cycle, from application to repayment, and they focus on underserved markets, such as SMEs and retail customers. Accounting for NBFCs involves several specific processes. Loans are recorded as assets, and interest income is recognized on an accrual basis. Provisions for bad debts are essential to mitigate potential defaults. Revenue recognition for interest occurs over time, adhering to accrual principles. NBFCs track operational expenses meticulously to ensure profitability. Journal entries encompass loan disbursements, interest accruals, and repayments. On the balance sheet, loans appear as assets, with borrowings and equity as liabilities, and financial ratios like the NPA ratio provide insight into financial health. For interviews at NBFCs like Bharat Finance, grasping regulatory guidelines set by the RBI is essential for operational compliance. Demonstrating knowledge of credit assessment methods shows an understanding of risk management. Be ready to discuss how interest income is calculated and stay informed about market trends, such as digital lending's impact. Familiarize yourself with financial statements and performance ratios to answer questions on financial analysis. Lastly, understanding the full loan process and the role of technology in service delivery will set you apart. That is your complete guide to this topic. If this video helped you, please like and share it. It genuinely helps us keep creating content like this. Drop your topic requests in the comments below. Subscribe to CandiMentor for more finance and accounting videos.